Is crypto setting up for an 80% collapse? For months, the market has been running hot, with Bitcoin holding near highs and altcoins soaking up fresh capital. But beneath the surface, danger is building. Although the prevailing narrative right now is that we are going to get a 5-year cycle running into 2026, not everyone is convinced. Although we agree we are going to get a lengthened cycle, it is important to consider the opposing view. One of those people that believe we are heading towards a market crash is Willy Woo, one of the most respected on-chain analysts in the industry. Willy says all the signals point to us being in the late stages of the cycle, the kind of environment that always ends with brutal drawdowns. What makes this warning hit harder is the history behind it. Every major Bitcoin cycle has delivered the same outcome, a violent reset that wipes out the majority of speculative gains. In 2014, Bitcoin lost nearly 85% of its value. In 2018, it crashed 83%. Even in 2022, after institutions had entered the market, Bitcoin still collapsed more than 75%. Woo believes this cycle could rhyme with the past, and once again, the numbers suggest the risk of another deep retracement is climbing. In today's video, we're going to break down Woo's latest analysis, why liquidity cycles and business cycles are lining up against crypto, and how treasury companies could add even more pressure if debt forces them to sell. Most importantly, we'll cover what his models are saying right now and why the months ahead could decide whether this market stabilizes or enters another historic reset. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin.
Yeah, first off, bear markets for me a time where I can kind of recharge a bit because it gets a little bit frenetic during the bull markets, and it's also the time where products can be built, and I have a few on the go currently, so it makes life a lot easier if you're building stuff. But certainly I do expect to be a market. Markets don't go up forever. We're a late phase into this current bull market. I know people are thinking, what do you call it, a super cycle or whatnot, and it's basically going up forever. I think we're due for a bear market pretty soon, just looking at the structure of the liquidity right now. So it could be developing right now over the last month. So it's a tricky also to know when the top is, because tops are unstable, but we do get a rough idea of when the danger zone is coming, and it's been building up for a number of months now.
Markets reward discipline, but they punish complacency. Willy Woo reminds us that bear phases are not an anomaly. They are a structural feature of how capital moves through crypto. Every surge eventually gives way to exhaustion, and right now the signals are leaning toward that exhaustion. Woo points out that while most investors dread downturns, they serve an essential purpose. They create the conditions for sustainable growth. When the market overheats, liquidity chases anything with a token symbol. According to PitchBook, venture funding for crypto startups hit over $26 billion in 2022 at the height of mania, but collapsed by more than 70% the following year. That collapse is not random, and it reflects how quickly speculative capital vanishes when prices cool. Woo views this reset as healthy. Bull markets crowd the field with noise, distracting builders and rewarding copycats. In contrast, a bear phase removes easy money, and only the serious projects survive. Ethereum itself was hardened during the 2018 crash, and out of that same winter came entire sectors like DeFi and NFT infrastructure. Woo stresses that cycles don't end because sentiment shifts, they end because liquidity weakens. Central banks, especially the Federal Reserve, expand and contract global liquidity by adjusting interest rates. Research from the Bank for International Settlements shows that Bitcoin's price correlates strongly with global dollar liquidity. When liquidity dries up, risk assets like crypto lose their fuel. Woo highlights that the current structure already looks late stage, with the market pushing higher on thinner support. In his framework, that marks the beginning of a danger zone. The key insight here is about instability at the top. Peaks are not smooth, they are unstable and often marked by violent swings. That instability shows that the market is struggling to find footing even as prices appear strong on the surface. Woo notes that he isn't in the business of calling the exact day of the top. Instead, he watches for the environment where the probability of reversal rises sharply. Liquidity indicators flashing weaker for months is one of those signals. The deeper message is about investor psychology. People want to believe in endless runs. Talk of a supercycle has become popular among those convinced institutions have changed the game forever. Woo's position is clear. Institutions can dampen some volatility, but they cannot erase market cycles. The structural drivers of supply, liquidity, and leverage remain in play. Pretending those drivers no longer matter is the quickest way to get trapped at the top. For Woo, the bear market is not doom because it is inevitability. It is the part of the cycle that clears speculation, sets a foundation, and forces capital to reset. That perspective reframes downturns as preparation rather than catastrophe. And for investors paying attention, it is a reminder that survival in crypto depends less on riding euphoria and more on anticipating when the tide is about to turn.
I mean, the 4-year cycle is kind of a cliche within our industry because it has been for 4-year cycles since the beginning. And, if you look at each cycle and you break it down, each cycle has been different. It's been different dynamics, different investors, different instruments, and the structure of the cycle has changed a lot. Yet we're still getting on these 4-year cycles. One of the things with Bitcoin is that we do have this 4-year halving, right? And that is up to now been quite reliable as, a supply shock, which is an impulse of, when you have the new supply rate coming down, you get this sort of impulse and the whole system has to rebalance. Presently, that force is waning, getting smaller because the inflation rate of Bitcoin now is half of that of gold. I think it's like 0.8% per year. So as we go into future halvings, that's going to dwindle. What people might not realize is that we have another cycle called the liquidity cycle, which is it's just the resonance that central banks print their money at. There's times where money is plentiful when they drop interest rates and other times where they tighten up. And historically, that's been on 4 years. And I think it's the superposition of both of these waves that have created our 4-year cycles. Now, there's this other cycle called a business downturn cycle. And that tends to be every 10 years, but it's not that, you won't set a clock to it. Let's say the last proper one we had was the world financial crisis in 2008. You could say COVID was one, but that was very, very a flash in a pan, very, very quick. And, central banks printed their way out of that very quickly. And so I think the economic shape of the economy is getting through downturn.
Cycles in Bitcoin are often explained as a 4-year rhythm driven by halvings. Every 4 years, the block subsidy halves, reducing the new supply of coins entering circulation. Willy Woo acknowledges that this has been the most reliable heartbeat of the market since inception, but he warns that it is no longer the whole story. Bitcoin's annual issuance is now below that of gold, meaning each new halving delivers a smaller shock to supply. At the same time, other forces, particularly liquidity cycles from central banks, are starting to play a bigger role in shaping crypto's path. Liquidity cycles are created when central banks loosen or tighten monetary policy. When interest rates fall and balance sheets expand, money becomes more available and capital searches for assets that can multiply its value. When that tide reverses, speculative markets dry up. According to data from the International Monetary Fund, global liquidity growth has been one of the strongest predictors of Bitcoin rallies, because the asset sits furthest out on the risk curve. Woo's framework sees halvings as one wave and liquidity as another. The overlap of those waves is what has produced the repeating 4-year cycle that has defined Bitcoin's history. There is also the business cycle, typically a 10-year rhythm marked by expansions and recessions. Bitcoin has never experienced a prolonged recession since its launch in 2009, which Woo highlights as an important unknown. If a global downturn coincides with a Bitcoin cycle top, the asset could be dragged down harder than investors expect. Equity markets historically fall around 30 to 50% in recessions. Crypto, being more sensitive to liquidity, could fall much further. Woo warns that this interaction makes an 80% decline a realistic possibility rather than an extreme outlier. This isn't speculation pulled from thin air. In every major Bitcoin cycle so far, peak to trough drawdowns have averaged around 80%. In 2014, Bitcoin collapsed from over $1,000 to nearly $200. In 2018, it crashed from $20,000 to around $3,000. Even in 2022, with institutions and ETFs in play, Bitcoin fell from nearly $69,000 to below $16,000. Each time, new investors assumed the cycle had matured beyond such extremes, only to watch the same percentage losses return. Woo sees that pattern as proof of Bitcoin's sensitivity to both supply and liquidity shocks. The critical insight is that each cycle is different in detail but similar in structure. Halvings are becoming weaker drivers, but liquidity still amplifies Bitcoin's moves. If liquidity contracts into a global slowdown, the downside could again approach levels that many investors believe are no longer possible. Woo's point is not about fear, but about realism. Cycles repeat until proven otherwise, and ignoring that history invites ruin. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
I think even though the weakness in our industry, let's say the infrastructure, the types of investments that are being made, anything like what we saw in the last bear market, with the likes of Lunaterra blowing up, testing the weaknesses in the entire ecosystem, Genesis Trading blowing out FTX. There was just this grayscale. The whole thing sort of had a sort of a domino effect of all the weakness points being tested. And I think this cycle, we have Bitcoin treasury companies, they might be a little bit frothy. And now we have digital assets treasury companies, even frothier. You might call this weakness, but I would say next to, say, the last cycle, it's stronger, and maybe some people think the drawdowns will be less. But I think when you think about it in terms of where the world economy sits, I think we'll get this 4-year cycle again. I think the drawdowns will be this time pulled down by the world macro markets. Mm-hmm. And Bitcoin being quite sensitive to liquidity is got a lot more to pull down than typical markets. So yeah, I could see an 80% drawdown again. No one really knows, but it's like, yeah, it's not out of the question. In fact, I think it's probable.
Every cycle exposes weak points, and the last downturn was one of the most brutal stress tests in crypto's history. Willy Woo recalls how cascading failures turned a bear market into a near-systemic collapse. Terra's Luna ecosystem unraveled first, wiping out more than $40 billion in value in a matter of weeks. That collapse spread to lenders like Celsius and hedge funds like Three Arrows Capital, which had been leveraged against Luna's stability. Then Genesis, Alameda, and eventually FTX fell, each linked by leverage and poor risk controls. Billions in customer funds vanished, and the industry spent over a year digging out of the rubble. Woo contrasts that with the present moment. He believes the infrastructure is stronger than it was during that chain of disasters. Exchange balance sheets are more transparent, regulators are watching closely, and riskier forms of leverage have been reduced. Spot ETFs now dominate flows, shifting demand away from offshore derivatives and toward regulated markets. But stronger infrastructure doesn't mean immunity. In his words, the industry may be healthier, yet Bitcoin remains tied to global liquidity. When macro weakness hits, crypto does not get a pass. That link to macro is critical. During the 2022 to 2023 tightening cycle, the Federal Reserve raised interest rates at the fastest pace in 4 decades. Liquidity drained from global markets, and speculative assets were the first to suffer. Bitcoin fell nearly 77% from its all-time high. Woo emphasizes that the sensitivity hasn't changed. If liquidity tightens again during a global downturn, Bitcoin could once more see drawdowns of similar depth. It doesn't matter that institutions are more involved or that the ecosystem is better capitalized. Liquidity is oxygen, and when it thins, the fire dies down. In every prior cycle, Bitcoin's price has collapsed by 80% or more from its peak. That's not because the asset itself is flawed, but because excess speculation unwinds violently when conditions shift. Equity markets may fall by a third during a recession, but Bitcoin, sitting at the edge of the risk spectrum, can fall 3/4 or more. Woo believes this pattern remains intact. He goes further to say that an 80% decline is not just possible, but probable if global markets weaken while crypto is still elevated. In the end, stronger plumbing doesn't change gravity. Crypto may not face another collapse like Luna or FTX, but if global liquidity tightens, the magnitude of Bitcoin's correction could still rival every cycle that came before.
Are there any similar hotspots or sources of danger that are of similar magnitude, which we don't know yet, but maybe some people are pointing to the treasury companies, and some obviously say Michael Saylor with strategy could be the big problem, blowing up and dragging everybody down. To me, this argument doesn't make that much sense. And also, I think that's something you said as well, and others, this market is more sustainable in the sense that it is like spot driven nowadays again, a lot more because of the ETFs and the treasury companies vis-a-vis like the 2021 bull market and then blow off top that we had. But yeah, do you see any similar danger zones, so to say, or sources of danger, we could point to as of now?
In the treasury companies, we do need to see will they be liquidated. Something like MicroStrategy, which has been using now 8 to 12 year out debt, meaning if your price is dropping into a point where you'd normally be liquidated, well, you've got 8 to 12 years for the price to recover to a point before you have to sell your Bitcoin to pay the debt holders their capital back. That's very safe. We're looking 10 to 12 years out of Bitcoin. Will it climb above the current price? So I think MicroStrategy is very robust around that, and the latest way they're doing it is with preferred stock, where there's not even a debt instrument on it. And so I think that's okay. There's been a lot of copycats that are trying different structures. Metaplanet, I think Meta could be liquidated if they time the market wrong and end up with a big bag of debt and can't sell through it to pay it off if the market turns, and some of the treasury companies are using 4-year debt and so forth. So we need to really see, it's very individual, and that's the Bitcoin treasury companies, and there's a whole host of Ethereum, BNB, a whole bunch of digital assets that are now starting to roll out. And we know those assets pull back often above 90%, 95% in a bear market. So will they be liquidated? If the question is if they will be liquidated, that'll really hit the markets.
The conversation around risk in crypto often focuses on exchanges, stablecoins, or token collapses, but Willy Woo points to a different vulnerability: Bitcoin treasury companies. These are firms that raise capital through stock or debt and then deploy it into Bitcoin, effectively turning themselves into leveraged vehicles for exposure to the asset. MicroStrategy is the most famous example, with Michael Saylor raising billions in debt to build a Bitcoin balance sheet. But as Woo explains, not all treasuries are created equal. MicroStrategy structured its debt with long timelines, in some cases stretching 8 to 12 years. That gives it breathing room if the market turns against them. Even if Bitcoin suffers a deep decline, the company doesn't need to liquidate immediately because it has years for prices to recover before creditors demand repayment. More recently, MicroStrategy has leaned on preferred stock rather than debt, which further reduces liquidation pressure. In Woo's view, that makes it relatively robust compared to the risks faced by imitators. Other treasury companies, however, don't have that cushion. Some have issued short-term debt with maturities as low as 4 years. If the market suffers an 80% drawdown during that window, they could be forced to sell Bitcoin to cover obligations. That liquidation risk is not theoretical. During the 2022 crash, over-leveraged miners had to offload hundreds of millions in Bitcoin to pay loans tied to their rigs and facilities. Those forced sales deepened the decline and created feedback loops that dragged prices lower. A treasury company with shorter-dated debt could repeat that effect on a larger scale. Woo singles out Metaplanet, a Japanese firm that has followed the MicroStrategy model but with a thinner balance sheet and more aggressive debt terms. If its timing is off, it could face liquidation pressure that spills into the broader market. Unlike MicroStrategy, which has years to ride out a downturn, companies like Metaplanet are exposed to immediate stress if liquidity contracts.
So this is a macro cycle risk model. Ultimately, this signal is picking up on liquidity. Underlying it is the core liquidity model I use. And so when it steps up high, that's an area of high risk, which means that the price is running away without the underlying liquidity support. I mean, you can see as we approach near the tops of the market, we get into a high risk zone. And there are dips, which are environments where, we can get recoveries. And then once we're at bottom, the liquidity comes in and the risk drops. And you see this back in 2017, and you'll see that even as the risk rises, liquidity is dropping away, that the market gets quite frenzied. And so we started the rise, say, in 2017 when the price was only $2,500, and it ran to 20,000. So, but once the liquidity starts dropping away, the clock has started on the cycle top. And so, there's a more zoomed in picture here. You can see as liquidity comes back in, the risk drops. We're structurally good with investors coming in. And so we're actually right now in a little zone where the price has pulled back so much that the liquidity underlying it is starting to look okay. And so it's sort of dropped a bit and it's going a little bit flat right now, which is quite unusual to see. You'll see again when we broke all-time highs, the liquidity started coming back in, and it was a healthy structure. And then in actual fact, a lot of speculators jumped on and liquidity started falling away, and that created a locally bearish area.
Late in every cycle, the signals turn fragile. Willy Woo uses liquidity models to measure when investor flows are no longer supporting the price, and right now those models are flashing red. He explains that when risk scores rise, it means the market is climbing on speculation rather than real inflows. That situation is dangerous because once liquidity thins, momentum alone cannot hold prices up. Tops form when prices stretch beyond what the underlying capital can sustain, and Woo sees that setup unfolding again. One of his primary tools is the macro cycle risk model, which measures how far the market has pushed above its liquidity base. When the index runs high, it shows that prices are detached from fundamentals. In past cycles, this has marked the window before major drawdowns. Woo highlights that the current readings are already in that danger zone. Another tool, the liquidity index, confirms the same picture. Whenever the index falls below a certain threshold, it signals that the market is living on borrowed time. The last time it happened was before the 2017 and 2021 tops, both followed by crashes of more than 70%. As of now, Bitcoin has again slipped under that line. External data supports his caution. A 2025 report from Fidelity Digital Assets showed that net flows into US Bitcoin ETFs slowed sharply in August and September after months of record highs earlier in the year. At the same time, the Federal Reserve's liquidity injections that had fueled risk assets earlier are now tapering. This divergence, prices holding elevated while capital inflows weaken, is exactly the pattern Woo warns about. It creates a market propped up by traders rather than long-term investors, which is inherently unstable. He emphasizes that this does not mean the crash begins tomorrow. Markets can stretch longer than most expect. In 2017, after liquidity support dropped, Bitcoin still ran from $10,000 to $20,000 before collapsing. In 2021, prices climbed back to a new all-time high even as investor flows weakened. But in both cases, the rallies were short-lived, and once they broke, the downturn was severe. Woo frames the present situation in the same way. The clock is ticking, and without a recovery in flows, the setup cannot hold indefinitely. For traders and investors, this is the point where discipline matters most. When liquidity diverges from price, the risk of sharp reversals increases. Crypto has always punished complacency, and Woo makes clear that ignoring these signals is betting against history. September and October, he notes, will be decisive. If inflows recover, the market can stabilize. If they don't, the pattern of late cycle weakness will almost certainly resolve the way it has every other time, and it is with a deep reset. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.